We got a market roaring today after Trump and Iran came out and said that they're about to have a deal up to 7,600. Hopefully the market gets open soon tonight. We're going to see those futures fly up tomorrow morning. Then just today in the video topics, we're going to say what are the valuation measures that we look at this market right now, and what do we use to look at the psychology to determine should we buy, should we sell, or what are other people doing to base our decisions based off of that. And then finally today, I'm going to go in based off of all of these and say what do I see in today's market and for the next 6 months to a year, possibly around that timetable, what is the market going to do and how should you position your money. Let's get right into the video today and go into the valuation metrics of the market, right? So today, we're trading at a 22.5 forward price to earnings in this market, correct? And we have the chart here for you guys to go and say, hey, you can go back and look at this. So make sure to save this video, subscribe to YouTube and like if you want to see anything more. But basically, this chart is saying, hey, if the forward P hits this level, a tsunami's coming, right? You're to be scared in the market because this market is very, very overvalued. And if the market goes down to this forward P, you're like, oh my gosh, I could genuinely 5x and 10x these stocks over the next 2 years just because the market's so low. Times that you've seen like this in 22. Think about last year, April, that V-shaped. Even the forward P got down like not even crazy this year. And the market's up almost 20% since then. So that's what we're kind of looking at with these forward Ps. And let's start with the forward P with the tsunami waves coming, right? Like, the storm sirens going off, you got a hurricane, you got something. It's like you're at one of these Carolina Hurricanes games. They're going crazy, right? This is what you're scared to come out there in this market. So basically, a 24 P ratio, whenever we've seen this was like right before January 2022. And what did the market do? It downtrended the whole year after that. Because what have had to happen to whenever that happened was basically, hey, everyone was buying it up. IPOs and all of that were going crazy. We don't care what valuations we're paying. We just want the stocks because this market is booming. We want to make money. And then you see it went all the way down to this, which we're going to get to later. And then the next time we had this big crash, right, was everyone thought Trump's going to come in and the market was so great his first term. This thing's going to get going. Like, we're going to the moon, okay? So that's what Trump and everyone thought was going to happen then. In this forward P of the S&P, right before this big crash, it got to almost 24. Same place again as that like January, right? Right before. And then we all know what happened after that. Huge crash, right? Then after that, this year we got to a forward P of just a little bit over 23, right? So this is what happened. And then we got a nice like 10-15% pullback depending on which of the indexes. And people got caught off guard in that, right? So that's what's kind of happened. So whenever you see that 24, you're like, okay, I'm scared. 23 is like, the alarm's going crazy. Like, you could get out, whatever, be like, okay, you know what? I'm not staying in here for that long because maybe the market's not going to go to that crazy of an overvaluation. Because what do we know about the market? It's like a pendulum, right? It's going to go way too high on the upside. And then people are going to freak out. I need to sell. The market's going down or everything's going up in smoke. And then you get great deals because they sell it off way too much. It very, very rarely is right around the midpoint. Because what are we? We're humans. We're greedy. We want the market to go high. And then we freak out because we're so short-sighted about anything. You see one thing that, oh my gosh, the news says this. It's not going to work out. So that's what it is. And then we got 22 to 23, right where we're in right now, right? That 22.5 we're at. It's starting to be overbought, correct? So it's not like, okay, red warning signs, everything are going off. You know, it's starting to be overbought. And if earnings get even better and better, you could see that forward price to earnings go down. Because, right, the forward price to earnings today is like the SPY or SPX, whatever that price is, divided by the next 12 months earnings per share. So say earnings come in and they beat the estimates of what they think they're going to be. That's going to make your forward P go down. And if the vice versa, if earnings miss the estimates, your forward P is going to shoot up because those companies are priced so high relative to that earning growth. So that's how you're deriving it. And also sometimes if you get a crazy high forward P, that could happen while we have a crash, right? Because sometimes the earnings are getting hit a lot more than the price in a crash. So your forward P might be insane even though the market's down 20, 30% because earnings have just taken such a beating. So that's just another thing to say. So then say you have a 4P of 20 to 22, which, I mean, we've had that for a little bit, like coming down off of this. Like we've been in there for a few month range. Like say, you know, that's a fair value in the market, 20 to 22. You know what? I'll take that, right? That's like long-term buy. Like you're not going to really get caught off guard there. It's going to take some crazy event to happen, some shock or something to get you down most of the time from there. Or even if you get a pullback at a 2022, it's going to be very short-lived, very fast. And then you start getting into the good times. The 18.5 to 20. Oversold, and these are good and great buying opportunities, right? Like this year, we got under 20. Down here, that's another time to talk about. But just look at whenever you get the peak, went down and then rallied right here. So if you see anything under 20, you're like, okay, I'm buying right now. The market, there's a very high probability that it's going to be going up. Maybe you're not all in yet. You're not all in, but you're like, okay, I'm starting to put off a nice thing. And then comes the time whenever you see the market under an 18.5 forward price earnings. And that's whenever you're like, buy, life-changing opportunities in the market based off of this 4P. Look what it got down into 22. Way under 18. Look what it got down April. Under 18. Look at this other time here, right? All the way down in 2023. Then you're going to see that, okay, the market's going to rally. So that's what you're kind of seeing in these markets is whenever everyone's so scared. And the craziest part is you're going to see all these other indicators with psychology that match up to the valuation to give you another confirmation bias. Maybe you could even use the psychology ones a little bit more. So basically, this whole thing is you want to put these together, valuations plus psychology to make your thesis. And also, like obviously at the end of the day, you've got to watch what's going on the outside world. Read the news because you've got to stay informed. But a lot of times, the psychology actually helps because something horrible could be happening that you know about. But if the psychology is so bad and the sentiment's so bad and the market's trading so low and it's sold off so hard, that's whenever you find your times. Because what do they say? The market bottoms about 6 months before the fundamentals actually get better. So that's why that psychology always runs ahead of the market because people are panic cushions or they're super greedy. So the first one I love to look at every single week. This comes out Thursdays, every single week, right? AAII investor sentiment. So basically, it's how bullish or bearish do people think the market's going to be in the next 6 months? And the first thing to know is not many people usually get over a 10% gain to beat the S&P 500. So whenever you're looking at these, you're like, okay, well, people are probably more wrong than they're right over time because they can't beat the market. So if you're a contrarian, you should be able to beat the market if 90% of the people can't, which the 10% of people who might beat it, maybe they're contrarians. So basically, just right off the rip, 1 year bullish high. That was the high in January before we got a rip down. And then the 1 year bearish high was starting to get to the end of March where people were like, okay, I'm scared. This is freaking me out. If you bought then in the market, you're up a lot of money on these stocks. So that's, and even if you went back to last year, the 1 year bearish high was the first week of April. And basically this contrarian indicator is like, I'm looking at this and I'm like, okay, we're bearish here, more bearish than the historical average. We're comparing it. Still more bearish, even though we're a little bit extra. But the spread, right? The spread of 6.5, it's less of a spread, just a little bit less. This is a way less of a spread. And this is, wow, negative 10% spread, which, like I said, we had in our videos last week. Hey, the market should still keep going. And lo and behold, the market's hitting 76, maybe 77 soon. So, I mean, that's how you can use these psychology. You can use them compared to the valuation and say, hey, people are still super bearish, even though the market's been running a lot. So for the market to go down, we got to flip over all these people to bulls if we don't have some crazy event that no one ever saw coming. So that's just what this chart's using for. And you kind of want to see, if you're bullish, you want to see, hey, a lot of people are bears. And if you're bearish, you want to see crazy amount of bulls where the market might be overvalued for a lot longer. And you're going to see bulls 20% plus, 20% plus, 20% plus. Either way, I'm pretty scared that the market's going to flip on them. So that's kind of what we're looking at, right? And then the next thing is the NAAIM exposure index. So this is really taking institution like hedge fund managers and saying, how exposed are they to the markets? How much cash and how much money do they have in and how much do they have left on the side to put back in? So anything under 100, alarm bells ring. The same thing as whenever you see that 4P over 24. The same thing as whenever you see the fear and greed for AI for a long time over 20+% bullish spread. That actually means that they're leveraged. They don't have any extra cash. They're leveraged. They're betting on the market going up. If the market doesn't go up, not good for them. They might be screwed. So that's what the 100 plus is. The 90 plus, you're starting to get to a red flag. I mean, there's not that much cash extra left going. Anything 60 to 80 is like, okay, maybe fair value and everything in the market. Like, okay, that's normal because, I mean, people are always more bullish. They'll probably be more in. Anything under 50, you're going to have some great buying zones right there, right? Anything under 50. And, like, this is a little bit different than these other ones because these are more, like, professionals in this. So maybe they should be a little bit better than these retail. But basically, I mean, look at how off guard they got caught. If you see these people really, really bearish, you like, I mean, how much lower can the market get? You're looking at these charts, like in October 22, whenever they only have like 10, they're about to be net short. Anything under 0% means they're short on the market. So like anything you get under 50% means, hey, they're over 50% out. Like they're going to get cash in fast. So anything under 50% is like, wow, like we're seeing over 100. Sometimes like they go up, down, because maybe they're hedging to go over like or something. So it's not always definitive, but like if you match that over 100 plus some crazy valuation, crazy good sentiment, if these three, all of them come in line, you're starting to get very scared about the market. Next thing you want to look at, this is more for your buying opportunities, like say the market's down a lot to show you, is the VIX. Anything, look at this chart, look at 2020, the market goes down, VIX went flying over 80. I think it got over 100, something crazier. That's like one of the biggest spikes since, it's only gone over 50 4 times since 2000, right? So the bottom of the 2000 great .com bubble, the great financial crisis, COVID, and actually last April, whenever the market went down over 50 and you saw what happened after all those recoveries, you had life-changing gains. So anytime you see 50 is like, you're all in that market, right? Everything is in. Growth stocks are going to fly because they're probably getting hit. You're getting stocks 80%, maybe even 90% down that you're like, wow. Just make sure they get balance sheets, they can make it through and the market's going to get going. 40 plus, great buy. I mean, like you're pretty much getting close to all in that market, right? You get anything 40 plus is like, you're probably 90%, 95% cash, whatever. And like 40 plus, you don't get that often, right? 40 plus, maybe you get that 5-10 times, like maybe double the amount of times you get 50 plus. So you should be like 95% to 100%, depending on whatever the market, how much it's down, right? 30 plus, good buy. You're getting a great deal. Like even this last one, 30 plus, it got down to. Just any of these times, even I think in November, it got down to 30 plus. So that's what you're kind of seeing. 30 plus it's not going to be a crazy drop usually, but it's a good buy. The only other time we hit like 30 plus and it still just didn't go was that 22, which you saw just how high that 4P was before. So that's why it just kept going. It's coming, nope, down. Because what was happening, the Fed just had to keep up jacking these interest rates because they thought it was transitory. They said one thing and just kept getting worse and worse and worse. And all of the big dogs just got smoked. That's what really got the market down. Whenever their profits and everything just smoked them in the air. And at the end of that, you got a crazy buy. So that's just what I'm looking at there. Another great thing is the fear and greed index, which whenever you're in greed for a while, you're like, okay, market top. But this isn't as good of like topping indicator, like as the AAII is usually a little better name, and the forward Ps of the market. But for the most part, the fear and greed, if you're getting this under 10, like under 5 is what pretty much mostly crashes, you're like, okay, we're pretty much bottomed. Anything you see under 10 and the fear and greed's like, this is great buying, like buy. You know what like that's what the fear and greed's doing. The put to call also is a pretty good, it fluctuates, but anything you really see over 1.2 is like great buy. The market's getting hit hard. Like look at these, just shooting at 1.4 at the bottom of COVID. Like everything got crazy there. This one got to 1.1. So this isn't as good as the other ones, but just can show you like, hey, people are like, if you see a put, that means more people think the market's they're betting that going down. So that means it's like peak scaring. And what happens whenever people are taking the market short or puts? They're going to have to buy this back, especially if they're going short, and the short squeeze happens. So if there's a lot of puts, there's probably a lot of people very short in the market, is what you're seeing. So now the part you guys want to see, what in the world is going on in today's market? So like we showed you, valuations are starting to get stretched. I mean, they're not fair value. I think they're a little bit extra stretched, in my opinion. And they're not, but in the red warning signs where we still could have time to run. Earnings coming great. The 4P could go down and we could keep this party going. Psychology, though, looks amazing for the market to keep up short term. I mean, look at that bearish sentiment, though. We have huge bearish. So that's something good to see in the market. I was looking at it last week. I'm like, wow, this is great. Now, this week after the deal and this stuff happens, it's going to shoot up high. Where if we got a little pullback after a little bit later this week or next week, that wouldn't surprise me. And the thing is, you have to understand is markets bottom on bad news, right? When did the last thing bottom? Whenever Trump said he's going to launch a nuke, pretty much. When did the April tariffs? Now that bottomed a little bit on good news, but you know what I mean? So they top on a lot of times good news whenever everyone's like, oh, it can't stop going down. This is great. And then you get it too stretched or something and get it go down. And markets are going to go to crazy valuations. And bull and bear cycles are going to go way higher than think and way lower. It's impossible to tell. They're people. They're greedy. They want to sell. They want to buy in their short term, like I said earlier. So that's the thing to keep out. The good news is, could the Iran war help being a topping measure of it? Yeah, in like maybe a month or two, everything gets good and everyone's feeling great about it. Buy way too much, get leverage. That could allow, well, everyone's like, okay, there's nothing else. We got election season, which markets don't like not knowing it's going to happen. So that's a lot. The other thing that scares me right now is there's a lot of IPOs marked top. So just go back to 22, right before 22. They had 4 times the amount of IPOs in 2021 than they had over the last 4 years. Because what was happening, there's super low discount rates. So everyone's like, okay, well, the discount rate, because of the interest rates are 0%, is going to be insane. So let me just go IPO and get a crazy sky-high valuation. And a lot of these companies that were unprofitable or growth stocks, they took advantage of crazy rates. So they're going to get sky-high valuations to raise capital where they come out. And all the CEOs ever in the company is going to get great money and they can sell. So that's mainly why the IPOs are there, because whenever people see the market's good or it's really overvalued, you want to get your stock out and you want to get going because you're going to get a sky-high valuation. And if you want to invest or exercise your options, you're going to make so much more money than if you enter an IPO in a bear market where you don't go public for that much. So that's kind of what it is. And this year, what do we have going on right now? SpaceX is coming out. Anthropic and OpenAI are announcing their intentions to go public. Some of them even saying faster than later this year, which SpaceX is coming out soon in June, early June, middle of June. OpenAI and Anthropic, if they come out pretty soon right after that, the biggest company is like, all right, the valuations are great now. Let's make some money. That's starting to scare me a little bit, just seeing all this happening in the market, because that's just that flurry of excitement where everyone's like, okay, the market can't go down. They got to keep going in. And these stocks get sky valuations and are scary with everything. So that's what I'm looking at right now. That plus Iran war could be some excessive exuberance, parabolic move in the market up. Maybe it goes even 8K and everyone's like, this market's not stopping. And then that's whenever you get that going down into midterms. And historically, you're getting something down into October and then the market's going to go up. Like after they're like, okay, who's going to win? Who's going to lose? So that's a weakness. But maybe this market goes a little bit more to get the crazy valuations, get crazy sentiment. We got IPOs, we got good news, everything's rolling good, way too many people leverage and margin, and then you just need something very little to get it down. And the other thing, like I was talking about, is the oil prices. So what usually happens before market tops? Let's just go back to 2025, right? Right before, lead up to that, right before everyone's like, Trump's going to come, he's going to have a great market, right? So investors, they just put in 1.5 trillion of inflows, obliterating the previous record set before the 2021 bubble, right? So people are putting in crazy amounts of money because they're like, he's coming in, look at his first time, the market's going to fly up. After the election, everything flew up in the weeks after because they're like, okay, all he cares about is the market. It's going to go up, go up, go up, go up. People are banking on tax cuts, deregulation, domestic production, and traditional crypto is going to fly up, so that gets more greed into the market. And what was going on at that same exact time that's happening right now, which maybe could go down if oil goes down and all the interest rates, people think they're going to go lower. But the 10-year was flying up. Because what happens, right? So say there's tax cuts and there's tariffs that he's going to put on other countries. What could that possibly lead to if people are being able to spend more money, business, right? You could get the market pricing in inflation, right? So the 10-year, right? Because it's 10 years around, like moves a little bit higher than like what the 10-year, the inflation expectations are going to be, because it's that plus like some yield, you're going to get percentage. So you can look at like at the 10-year tips to say, hey, what are the inflation expectations? And the 10-year tips, the 10-year yield pretty much move the exact same way, which a little bit extra risk versus reward. So basically, also if there's a fiscal deficit because we're spending so much on to put back in our economy, we could lead to more money printing, more inflation. So basically, right now we got people are starting to be like, okay, the market's coming back, oil's going to go down, everything's going to go good, and we're going to start going up. But we still got this 10-year high. And whenever your 10 years high, people are like, okay, maybe I'll just take my money in here instead of putting it in the market, because you know what I mean? Like I'm scared a little bit going on, and I'm getting this great 4 or 5% almost yield. So that's why the treasury, and that's why discount rates go up. If the treasury goes up and higher discount rates, go back to our other video, and you're getting lower intrinsic values. So basically, just looking at this, we have some similar scenarios from the past where if these big companies go IPOs, or like the valuation is rich, could be dangerous. And what are people banking on? What if it doesn't work out? What if the valuations get stretched out? So thank you all for listening. I mean, right now I think markets should go up, just keep trending up a little bit. There's nothing excessive in the market yet. There's no crazy IPO runnings. 10 years higher, and it's probably going to start tracking down after the war's going down. Oil is going to keep coming down. But all of that good stuff could lead, even if the Fed says, hey, we're going to cut interest rates with Warsh, because he said, hey, we're going to keep rates lower. We're going to let inflation run hotter. That could lead to something. And the last thing, if you want to do, you want to project out your stocks or anything, we have a free beta out for Gamma. So you're going to have access to institutional grade information, a step-by-step research process, and it's investor software made by investors to help you get better gains and understand your stocks and always run the numbers like we did today, looking at them to just not go out there and say, hey, this stock's going up because Sally said it was a good stock, or Tom Lee was on here saying it was a good stock. You actually have your thesis, you have your numbers, and you know if it's a buy or sell, and you're not listening to other people who are freaking out and maybe aren't frankly great investors that you can be.